this net investment income tax is something that started last year. It is part of the Obamacare taxation, and what it is it applies when a person's modified adjusted gross income, when it exceeds $200,000 for someone who's single or head of household, $250,000 for married filing joint, and $125,000 for taxpayers when they're married filing separate. Now, one of the things is that the thresholds are not adjusted for inflation. And that always frightens me a little bit because $200,000, $250,000 might seem like a lot of money today, but I wonder what it will look like in 10 or 15 years if we'll all of a sudden think this. So,
Brian, can you distinguish between adjusted gross income, which is on the bottom right of your 1040 you file every year, and modified adjusted gross income?
Well, what modified adjusted gross income is, that's where they take away they either take away or add in certain items to come up with this number. So, for example, and we'll get into some examples of what's included in the income here in just a moment, in terms of what's included in net investment income, for example. But it's kind of a side calculation is what you call it. But again, this tax then is going to be 3.8% of the net investment income that's going to be above that threshold. So if someone is married filing joint and they make $275,000 and some of that money comes from investments, then 3.8% of that is going to be subject to tax. And here's an example that we'll see here. Here we've got Matt and Joanne. They're married, and for 2014 they've got modified adjusted gross income of $275,000. So that $275,000, $50,000 of it comes from net investment income. So when they go ahead and do this calculation, we're going to take $275,000 minus $250,000 and multiply it by 3.8%, and that's that net investment income tax that they're going to have to pay. That's going to be $950. So it's not going to be based on the full $50,000. It's just based on their income above the $250,000. So if we were to assume the same facts, except that their modified adjusted gross income is $375,000, well, in that case, they're going to owe a net investment income tax of $1,900 because, again, that investment income is $50,000. So it's going to be $50,000 times 3.8%. So, again, this is where they're going to be subject to the net investment income tax in their situation. Again, their wages, their income from earnings is not subject to net investment income, but their investments are.
Brian, we have another question.
Sure.
In terms of municipal tax exempt income, is that added back into modified from adjusted gross income, or is it not?
It is not. In fact, that's one of the things you'll see on this next slide here is here's what's included in the net investment income. It's going to be gross income from taxable interest. So tax-free interest from municipal bonds, that is not going to be included. That is excluded. Income from ordinary dividends, that is going to be included in this. Gross income from annuities, and that's from non-qualified plans, that's included in net investment income. If you've got income from rents and royalties, or for perhaps businesses that you're not really involved with, those would be passive businesses, that's included. Capital gains, those are included. So remember the capital gains rate, we said was 15%. Potentially your capital gains rate could be actually 18.8%, or if you're in the highest tax bracket, it could be 23.8% when you add this net investment income tax on there. Also, a child's interest in dividends and capital gains that are not, if you have children who are subject to the kiddie tax, those would be subject to the net investment income tax. So all of those things are reported there and are included in this calculation of net investment income. So but there are deductions that you can take. You can take investment interest expense. You can take state and local taxes using any reasonable method. You can take investment expenses, deductions that are allocable to gross income from your rentals and your other business activity, penalties on the early withdrawal of savings, and then as well any tax preparation fees that you can make applicable to the investment income. So those are some deductions that you can take against the net investment income tax.